Major funding for these broadcasts is made possible by grants from Chase Commercial Term Lending and New York Community Bank, M&T Bank, Perfect Building Maintenance, Capital One Bank, the Witkoff Group, Greenberg Traurig. Additional funding is provided by grants from AKA Hotels, Corman Communities, Ariel Property Advisors, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Colliers International NYC, CPEX Real Estate Services, Cushman & Wakefield, Customers Bank, DDG, Dime Savings Bank of Williamsburg, Douglaston Development Levine Builders, Fisher Brothers, First Nationwide Title Agency, Flushing Bank, Foley and Lardner, Friedman LLP, Handler Real Estate Organization, HAP Investment Developers, Herrick Feinstein, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Chairman USRealty.com, John Katsimides, Red Apple Group, Kilroy Architectural Windows, New York's Window Company, Madison Realty Capital, Massey-Knackle Realty Services, Matone Group, Mercantile Commerce Bank, Meridian Capital Group, Newmark Grubb Knight Frank, New Banks, MHP Real Estate Services, People's United Bank, SJP Properties, Sterling National Bank, Sterling Risk, Stonehenge Partners, TD Bank, Terra CRG, The Continuum Company, CUNY TV Foundation, The Moynihan Group, Urban American, and These Friends.
Everybody wants to own real estate. Everybody hears about it. They want to be in the real estate business. So they say, maybe I'll buy a share of a REIT. Maybe I'll get into a TIC. And there's this new idea, crowdfunding. You know, everybody's on the internet, crowdfunding. What is it? I don't know. Now, I really know a little bit about it. So today, I brought an assortment of individuals who are involved in all different aspects of crowdfunding, being a crowdfunding company, a real estate developer, and the counsel over here. My guest today includes Steve Bettinger, who is the co-founder of Acquire Real Estate, Chad Gesson, who is the principal at Chatham Development, Dan Katz, who is the principal at Katz Properties and also a shareholder of Acquire Real Estate, Dan Miller, who's the co-founder and president of Fundrise, and last but not least, the legal counsel over here, Rick Morris, a partner at Herrick Feinstein. So what happened in 2012? Something called the Jobs Act? What's the Jobs Act? In simple language, what the Jobs Act and creation of this crowdfunding idea.
Okay, the Jobs Act is the federal government's way of giving everyone an opportunity to invest as a community. So it's really community funding, not just crowdfunding. Now there's a part called Title III, which everybody's been talking about. There's a lot of restrictions, and there's for the real estate people, the biggest important part about it is the most you can raise is $1 million per year for all the companies that you control. But what's really great about the Jobs Act is that it creates a new way of raising capital.
So wait a second. This man who's a real estate company, and this guy who's in the real estate business, he can only raise $1 million from this guy who's in the crowdfunding and $1 million from him?
Technically, they're only allowed to raise $1 million from everybody in the year, but that's Title III, which is not really the story. The story is what Title III represents, the new way to raise capital, the use of technology to distribute securities to investors. And it's a portal. It creates a new thing called a funding portal where you'll have the investors through one of you gentlemen to the actual developer.
Today, if you go to the internet and you search the term crowdfunding for real estate, you'll find approximately 100 different entities in different variations around the country. And, you know, I'm not putting who's good, better, and different, but I'm fortunate that I have a relatively new company with some good principles over here, and I have one of the leaders who originally started the first one. So how do you guys go in there and tell me a little bit about Fundrise?
So we began from the development side. My brother and I founded the company 4 years ago. Our family was in real estate development in DC, and we built the platform initially to raise capital online for our own deals. And as you can imagine, talking to developers a few years ago, they had lots of questions. How's the legal going to work? What's the admin going to work? So we built the platform ourselves, Fundrise, did our own first few deals. Then developers, groups like Chad, reached out to us, asked to use the software, and now it's a platform.
Now, you told me prior to the show you raised $39 million from some major investors. Why do these investors want to go into a company like Fundrise? Right. Are they looking at Fundrise or companies in the crowdfunding space are the next Googles or the Yahoos or around?
Yeah, we raised $38 million total for the business. We think of it like e-commerce in the early 90s. There's clearly, you can now distribute investments online, you can raise capital, manage investors online. How's it going to play out? Who are going to be the leaders? There's a lot of questions, but the market share and the potential market size is huge.
So how many people have signed up to be a possible person to buy an investment on Fundrise?
38,000 people on the site and over 1,000 real estate companies, so demand on both sides of the market.
Now, you raised money recently on Fundrise. Your family business has been around for over 30 years. I think you started in 1982 with some developments over here. You've raised money in a variety of other ways. Why do you decide to use this new mechanism to raise money?
I think it was a natural fit for us. We're a smaller, family-oriented real estate development company. We don't do a lot of projects. We do the projects that make sense to us. And we really focus on developing from the perspective of building a product and designing it and constructing it. And we control that whole process end to end. And the one piece of our family business that's not well developed is the finance end, is the going out and meeting investors and courting them and talking about our deals and doing all of the serious legwork that it takes to attract multiple investors. So over our history, we typically relied on 1 or 2 high net worth individuals or families to come in as our venture partners and provide us financing and some financial backing to help us develop these large projects.
So tell me project that you raised money on Fundrise.
So Fundrise, we decided to give it a shot, this crowdfunding idea, with one of our smaller types of projects, which is a short-term 12-month development or redevelopment of a waterfront property in West Hampton Dunes, New York, where we acquired an old shack house, beach hut, I guess you'd call it, and we knocked that down, constructed a new house on top of that that was going to be a luxury 3,500 square foot waterfront home. We put up 55% of the cash required to build the project, and Fundrise came in with the other 45%, which was $1 million. And
how large are the investors? Are they, I mean, dollar level? Is it $10,000 minimum, or is it $1,000?
I think it was a $5,000 minimum.
$5,000 minimum.
And how many did we end up with?
78.
78 investors.
You had 78 investors. 5,000 was the smallest or the minimum, and what was the largest?
180,000?
I don't really know. That's not information I get from Fundrise.
But 180,000. Between, I'd say, 5K and 100 is the normal range, and then there's a few groups, family offices, super high net worth, who are bigger.
So now I have 2 guys here from Florida. How do you leave the asset-based business and go decide, because I can hear the Millers over here, the family was in the business, and they understood technology and they looked to go a different growth. How do you decide to go into this business and become a new real estate crowdfunder?
Well, our core group of partners are real estate people and background, and we felt that there is a need for access, and we believe that our platform provides high quality institutional access to accredited investors around the United States.
Now, would you want to explain what an accredited investor is?
An accredited investor is a type of investor that meets either a net worth standard or an income standard. And it's the kind of person that the SEC has taken the position is sophisticated enough to be able to ask the right questions and do the right due diligence for an investment. As a result, what you've been doing, I think, is most of your fundraisers under Regulation D. As a result of that, The investors do not need the protections of the full, robust disclosure of a public offering document.
So how much is it's $200,000 individually?
300,000 joint.
300,000
Or a
joint,
million net
200,000 for
worth.
the last 2 years, or $1 million of net worth without counting your primary residence. You count the debt on the primary residence, but not the
And
asset
to-
value.
So here's a question for you. You're in the real estate business. You've been raising money over there, and you decide that you want to do some work with Acquire. Why? And in the same question that I asked Chad before, why do you decide that this mechanism, as opposed to the friends and family, because you have that network, you could even go to the Ramaz network, into this situation.
Sure. Well, I think it's the natural progression of the syndication business. That's what we're ultimately in, but we are fully integrated from acquisition all the way down through management and leasing. I think the opportunity therein lies that there's this abundance of capital sitting on the sidelines that doesn't have access to developers like myself or Chad. Most people might know one or two people that they can invest with or that they feel comfortable with. Ultimately, what both Acquire and Fundrise are doing are allowing people from around the country, ultimately around the world, to gain access to high credit-worthy sponsors. And that's a lot of the focus from the Acquire standpoint has been giving people access to groups that we've set a pretty high threshold, to groups that have been in business for 10 years or longer and have several hundred million in assets.
Now, here's the question. You are raising equity where somebody's going to own a piece of a transaction. In your case, a shopping center or a development, and you said to me you're now also raising money for a hotel investment. Your situation was debt, where somebody was going to get a coupon, get some interest on the rate.
Well, our situation actually was equity also. It was preferred equity. So
Preferred
they were
equity,
getting a
but
fixed
preferred
return.
equity in the manner of really, preferred equity is a form of debt. They don't really own anything. They're getting a coupon on that type of situation. I mean, if we really want to get into that technicality. The investor who invests on debt is one type, and an investor who invests to own is a different type. Would you agree?
Yes. And part of what Acquire and our competitors like Fundrise are doing is we're offering different types of investments from different areas around the United States or abroad and different asset classes. So a particular investor might be interested in certain cash flowing grocery anchored shopping centers in Chicago, or multifamily in Miami, or industrial in Los Angeles. So we want to offer a wide variety of high quality institutional deals. So it gives the investor the opportunity to diversify their own real estate holdings, manage all of their investments across a user-friendly platform, and then be able to manage everything accordingly.
And we began with equity and we moved more towards preferred equity and debt. I think finding that investors found it was simpler to understand. They can get a fixed deal, they have a fixed term, like Amazon selling books initially. People were just buying online for the first time. They know a book, they know what it is, it's a commodity, and then fashion took another decade.
Let's utilize Chad's in a way as an example so my viewers can understand this.
Right.
There's $1 million raised, and it's called preferred equity, but it's a form of a debt, and the person is getting a coupon. What is the interest rate that they're getting on this loan?
They're getting a 10.5% annual interest rate.
And when do they obtain this 10.5? Do they get it monthly, or is it accrued at the end when you sell the house?
It's accrued at the end when we sell.
And for that service, what do you charge him, okay, traditionally, not specifically on this transaction, what is the developer or the person in his role pay to you for that service?
Traditionally 1 to 3 points. So it's similar cost of capital of a mortgage broker or somebody providing funding.
Okay.
So I'll throw something out there as well. Katz Properties beta tested a deal for Acquire over the summer as the first deal as Acquire came out. It was a $30 million shopping center, Publix anchored in North Fort Lauderdale, and Acquire took $1.5 million of the equity as an equity investor in that deal.
So let's talk about what does the investor expect to get on that transaction? Because on all of the websites that you have, the two of them, which are really fine websites, and I recommend people go to the Acquire Real Estate and the Fundrise because it has some good details. What are you projecting to the investor for equity as opposed to this debt over here where it's a coupon number. What is the potential for that investor?
Well, Katz Properties is paying out to acquire and all the other investors in the deal on a quarterly basis. We anticipate the yield being just over 8% cash on cash going in net to investor.
Now, there are other avenues, okay? Being a REIT, why wouldn't somebody invest in a public REIT or a private REIT as opposed to crowdfunding?
Well, there's a couple things. First of all, let's be clear, Title III crowdfunding doesn't exist yet until the SEC does announces the regulations. But what everyone is talking about is really more community funding. You're using the same regulatory exemptions from a public offering, but you're offering the securities in a better way. You're leveraging technology. And things have changed, and things are never going to go back to the way that we used to raise money, which is a placement agent that went to a select group of people that they called. Now, why a REIT versus a private equity?
I mean, look, I could buy ownership, I could buy some REIT shares,
right,
and I'm not going to get a 10% return. Now, there are REITs, there are mortgage REITs, like Apollo, like Starwood Property Trust, and a variety of others. And they're not, they may be giving a return of 6% to 7%. They're not talking about a double-digit return on debt. So, it seems that the returns can be higher in the crowdfunding source, even though all the legal technicalities may have not been approved. For that borrower or for that person, it's like having a piece of the rock, having the opportunity.
Yeah, I think it's important to understand that with Acquire and a lot of our competitors, you're actually buying directly into the real estate. So you're not buying a security that owns the assets. So we think it's very important, and we think it's part of the human side of the investment is you have an actual ownership in that building. You can visit that building. You might own, obviously, several bricks of that building, but you do own the actual building. And with Acquire, 100% of your investment goes directly into the real estate. Yeah. So we think that's a big differentiator.
Okay.
And I think the extra return comes from the fact that it's direct using technology as opposed to private REIT, which is 13 to 15% in between. So the kind of comparison we use is mutual funds to ETFs. Managers used to charge points for mutual funds. They actively were trading, and it realized better way to put out capital is as low fees as possible directly through ETFs. And I think the similar comparison is a lot of middlemen between the capital and the eventual deal it goes through. I think low fee efficient vehicles online may be a better way to provide return.
And that's the part, because what we're doing is we're still selling the same product, but because you're leveraging technology, you're able to sell it in a more efficient way. You're able to distribute it. And the investor, because of the technology, because of the portal, is able to get more information about the particular building, about the particular investment. These type of investments were really only available if you went to a private equity fund that had a focused opportunity in real estate. And so you were actually allowing someone else to make your investment decision. Here, people have the opportunity, and you wouldn't be able to do this without technology, but people have an opportunity to say, I want this building or this building or this risk or that. And so what it really is giving us a wonderful opportunity for, what the SEC is doing,
it's like
you have
going to McDonald's and looking at
exactly.
the chart, okay?
Or down the street.
I want a...
Wendy's.
More healthy, hopefully.
Okay, I want the dollar deal, okay? Or I want the package. But in a way, it's there. Now, here's the question that I have. You've done all these deals. You guys are new kids on the block. You haven't done that. What's the profile of the investor?
There's two different pools. For the accredited only deals, where it's $1 million net worth or $200,000 income, it's mostly men between 30 and 50. But for deals we've done Regulation A public offerings, meaning anybody could invest for as little as 100. That's way across the map, from 20 years old to 88 in the last deal. In
order to close on these transactions, we have what we call a time of the essence, or you need the money. The money may not all come in before the transaction takes care of it. How do you, as a acquire or a Fundrise, take care of the closing and then get the money later on?
Sure. We have a sidecar fund, which basically is a certain pool of assets, certain pool of capital that is available to close a deal. So when we say to a sponsor, we're going to fund $1 million, for example, we know we're going to close on that $1 million and then, of course, offer that $1 million opportunity to our investor base. So the sponsor's happy that it's a committed amount of capital that they can count on. we're happy. We know we can close in a timely fashion. Our sponsor can negotiate terms accordingly, and then we can close on time and efficiently.
Yeah, similarly, we now close on balance sheets. We have our own equity capital with a credit facility that we close on and then sell the position down. So that was required because if you're a real estate operator, your competitive sources of capital, our competition's not other crowdfunding sites, it's another mezz fund, another private equity fund, and they can close on
Now,
balance sheet.
you know, people who like owning real estate, they like reporting. It may come out once a year with the K1, which I assume you have a similar situation that you have to come out with either K1 or some type of other certificate over there. What type of reporting is available to that investor who's, saying, hey, I put the money in, I'm in Dubuque, Iowa. I've heard of West Hampton Dunes. I don't realize where it is. What type of information, or tell me about what kind of sales the Publix is doing, over there.
So we've had, as Katz Properties and one of the owners of Acquire, a lot of experience. We service a couple of 100 investors ourselves for the last 10 years with quarterly reporting, all the way down from public entities that have invested with us, all the way down to the individual mom and pop accredited investor. And certainly we know the kind of the hot buttons
So
that
you
people
understand
want.
that, wait, and the Millers understand it because
Absolutely.
they've been in the business also. But what type of reports are you going to provide to that investor? That's what I'm really...
So what we've been doing, there's someone at Fundrise who's, we keep in touch with, and we provide, we'll provide annual reports, as you said, K1s and things like that, but informal reports come out from us, much more frequently than that, usually every other month, especially this project was a construction-related project. So, if there's some photos or there's an update on marketing or we start advertising, we will send an email over to Fundrise and say, hey, here's our latest piece of marketing, here's what our sales traffic has been like, and so on and so forth, and then they'll push that out to all their investors. And I think it's very nice, and I think that's sort of the idea behind that.
Yeah, so we have a communication part of our portal as well that distributes the content and the information from our sponsors down to the individuals. It distributes the cash flow and distributions, the K1s, and any type of communication that's relevant to the asset. What's also important is we also have a search component to our investors, so they can kind of toggle on anything they're interested in seeing and not seeing things that are not of interest.
One of the negatives of investing in real estate in general is the question of illiquidity of that. Somebody may need money at a specific time. There is a death in the family, the investor passes on. How do you take care of that question?
Well, as you're correct, generally speaking, real estate is a relatively illiquid asset or investment. We do have a plan for a secondary market within our portal to have that opportunity to trade assets.
Yeah, most of our assets or deals are structured as 3 years or below, so they're with construction financing paid out at sale of the house or refinance. So we've done that for liquidity reasons. It naturally matures.
No, but what happens if somebody comes? I'm not.
They can transfer within their state, death, dissolution, so they can transfer.
But what if somebody says, I need the money, okay? I heard that there are people in Chad's deal who are at $5,000 and $180,000.
So we've done share buybacks at par plus accrued, and that's something we're going to instill. So I think the company needs to buy back to create some liquidity, but ultimately it's a security that's traditionally having very liquidity.
And there's the thing, you have a security, so there are other ways to sell in a secondary market under Rule 144 and other things, because you're actually selling preferred stock. So people can trade preferred stock in a secondary market as long as you provide a certain amount of information, which you now have the technology to do so very efficiently.
Unfortunately, I'm a big viewer of a show called American Greed. And, there are people who are not always that honest in every business, okay? And there's not a question that the people here have met that smell test. But there are other people out there who really don't have the true understanding. How does that investor touch, feel, make, I'm not saying you, how does that person make that decision? It's a hard decision because, as I brought up prior to the show, most of you have a similar looking website because you're trying to show the type of things.
So our site is very transparent, and we try to promote our sponsors. We put their websites, their historical information, case studies, a history of what they've done in the past. So we're not a listing service. We won't take anyone that wants to raise capital for a real estate opportunity. We vet these people. We understand their history and their success levels, and then we'll present those.
I wanted to raise money for a bridge I'm planning to build. You know, it goes
In
over
Brooklyn.
in
Accept you.
Brooklyn. You know, you.
Yeah, I think that's something that's going to have to play out over time, credibility. And what we've done is certain sponsors like Silverstein Properties and Forest City have invested with us. So trying to create really high levels of sponsorship, trying to feature them, creating a platform profile. But ultimately, it's going to have to be done over time with returns. Like I said,
Yeah.
e-commerce, it's early.
Now, I didn't notice people when they do an internet search, there are placements that you get names, and then there are ads. There are a number of these fund companies, crowdfunding real estate companies, who are ads over there. So people, click and you pay a fee for that. How are you promoting your businesses? How are you marketing? I know there's lots of articles in Fortune and Forbes and the Wall Street Journal, but how do you get the news out?
Well, I think it's important. We use a lot of social media, and I think, to your point, to the end of the day, it's the quality of the deal that will ultimately let the surviving company survive and prosper.
We found that press by far is the biggest spike. So anything in the Times, Wall Street Journal, Fortune, that's what really drives huge sign-up growth. And other than that, it's network effects, friends of friends signing up on the site. And a lot of the initial group of people that are investing are real estate associates, real estate brokers. They're in the industry, and that's the first group.
So I think in summation, in order to really do the right thing on this, later on in my 14th season, and I am a social media maniac because you can find us on Facebook, Twitter, LinkedIn, and all the rest, and also the Slowly Report app for iPhone and iPad. I think I'm going to definitely invite you back because it's a very intriguing concept. I think it's a concept that has come, as Rick has said, it's here, and I think it's something that people should evaluate. And I'd like to thank Steve, Chad, Dan, and Rick, and I'll see you next week.